Something is about to break open in the silver market, and most people are going to miss it completely. China has been silent all week. The Lunar New Year kept the world's largest physical demand engine completely dark. Silver did not care. It climbed anyway. By Friday's close, silver futures were printing $84. 57 in the crowd was celebrating like the war was already won. They have no idea what Tuesday actually means. The bulls are excited about a move that happened without China, which means they have not yet seen what happens when China wakes up. Shanghai reopens Tuesday morning, and there's a physical bid already running inside that market that Western traders cannot explain away. A major silver recycling operation in Shenzhen, one of the most active precious metals hubs on the planet, was offering the equivalent of $93 per ounce to buy back $9.99 pure silver going into the weekend. Western futures are sitting at $84. Shanghai spot was already trading at $86 before the holiday. That is not a rounding error. That is a $9 gap between what the physical market inside China is willing to pay and what the paper market in the West is currently pricing. When Shanghai reopens, that spread does not stay quiet. It never does. But before we get to Tuesday, we need to talk about what is happening right now inside the structure of the COMEX, because this is where the story gets uncomfortable for everyone who thinks this is just a normal bull run in metals. COMEX registered silver, the metal that is actually warranted and genuinely available for physical delivery against futures contracts, sat at 88. 19 million ounces going into the weekend with zero new inflow. Not a single ounce of new metal entered the deliverable pool. The February contract finished. The drain continued in eligible silver with another 2 million ounces, leaving the broader vault inventory in a single session. Total COMEX inventories are bleeding out on a net basis, even as the registered figure holds flat, and that flatness is not stability. It is stagnation at a moment when the market desperately needs replenishment. Here is the number that should be keeping every serious trader awake right now. The March silver contract still carries open interest, representing approximately 222 million ounces of theoretical delivery obligation. Registered silver is at 88 million ounces. The gap between what is owed and what is deliverable is over 130 million ounces, and the clock is running. 4 trading days remain before March enters final settlement, and the roll from March to May has been moving at roughly 15 million ounces per day, which means the math does not close. It cannot close at that pace. Something has to give, and history is very clear about what happens when delivery demand meets a vault that cannot answer it. The mainstream financial press is not covering any of this. They are writing headlines about gold reclaiming $500 and celebrating the weekly close like they understand why it happened. They do not understand it. Both gold and silver made significant moves this week with China completely absent from the market. And nobody in the financial media is asking the only question that actually matters right now, which is, what does this market look like with China back in it? Let me give you the context that frames Tuesday in a way that no mainstream outlet is going to touch. The Silver Institute has now confirmed we are in the 6th consecutive year of silver running a structural supply deficit. Annual global mine production sits at approximately 800 million ounces. Current projections for 2026 show a deficit approaching 300 million ounces, which is more than a third of everything the world pulls out of the ground in an entire year. That is not a projection built on optimistic assumptions. That is the output of compounding years of underinvestment in primary silver mining, accelerating industrial demand from solar panel manufacturing, electric vehicles, and advanced electronics, and a physical market that has been held together by paper forwards, lease arrangements, and rehypothecation that cannot function indefinitely under real delivery pressure. The LBMA, which sits at the center of the global silver lending market, gave everyone a warning shot when lease rates exploded after the interdealer lending network inside that hub effectively seized. Banks that normally lend silver quietly to each other inside a closed, informal network had to go public to borrow metal. When the private cushion disappears and institutions have to advertise publicly that they need to borrow silver, it means the informal buffer is gone. That event was documented, it happened, and the market moved past it without understanding what it actually signaled. What it signaled is that the paper structure built around silver was operating without the physical inventory needed to back it properly. And when real delivery pressure arrived, the system had to show its hand. Howard Marks wrote in Mastering the Market Cycle that the critical moment in any asset cycle is not when fundamentals shift, but when the credit and liquidity structures built around an asset are finally forced to confront physical reality. The LBMA lease rate explosion was exactly that confrontation, and it was not the last one coming. Now, I want to tell you about something that has not been widely reported, but that connects every piece of this story in a way that changes how you read the current setup. Over the past several months, a sequence of events unfolded between JP Morgan, Chinese industrial buyers, and the COMEX silver market that explains a significant portion of the structural tension you are seeing right now in the data. Chinese industrials had spent years buying silver on every dip, conditioned by decades of suppressed prices to treat weakness as opportunity. That behavior created a structural short position among Chinese industrial hedgers who assumed they could always cover at lower prices because lower prices had always come. When J.P. Morgan reclassified 13 million ounces from COMEX registered to eligible inventory, removing it from the deliverable pool without warning, a Chinese industrial attempting to take physical delivery on a futures position was told the metal was not available. What followed was a localized short squeeze that went limit up as covering orders hit a market that had no depth to absorb them. J.P. Morgan then spent weeks sourcing silver concentrate from Latin America to fill that order, while Chinese buyers attempting to access the same material were told it was already contracted. One Latin American producer confirmed receiving offers from Chinese buyers at $80 per ounce, a full $10 above prevailing market prices, because the supply had already been locked up. Vince Lancy of the Goldfix newsletter documented this sequence in detail, and his framing is worth understanding directly. This is not a metal story in the traditional sense, it is a proxy conflict. J.P. Morgan operating as a representative of Western financial interests, the PBOC and its market proxies operating on the other side. Silver is where that conflict is most visibly expressing itself right now, and the COMEX March settlement is the next scheduled moment of truth. Inside China, the story got more complicated during the move higher. A listed open-end silver fund was trading at 30% above its net asset value as retail money and speculative capital piled into the trade. Chinese industrials who needed silver prices to stay lower to manage their own short exposure pressured regulators to intervene. The fund was switched to liquidation-only mode while silver was still elevated. If that sequence sounds familiar, it should. The Hunt brothers would recognize that playbook immediately. The critical difference this time is that forced liquidation did not kill the market. Silver held because the physical demand underneath the paper structure was too large and too real to be destroyed by a single regulatory intervention in a single country's market. Let me give you the honest counter-argument, because this channel does not operate on confirmation bias, and the people who actually manage capital need to understand the variables working against this setup before they can properly evaluate it. A stronger dollar creates mechanical pressure on dollar-denominated metals, regardless of physical fundamentals. The yuan strengthening to its strongest level against the dollar since May 2023 is notable and cuts both ways. A stronger yuan reduces the currency hedging incentive for Chinese buyers and can dampen the import premium dynamics that drive physical demand above exchange prices at the margin. Silver's move from $79 to $84 in a compressed time window has also created a cohort of traders sitting on short-term gains who will look for any reason to take profit before the next leg develops. Supply-demand projections, including the large deficit figures being cited by institutional analysts, are forward estimates, not realized outcomes, and supply responses to high prices do occur over time. These are real variables, not excuses for ignoring the bullish structure, but anyone deploying actual capital has to account for them honestly. What the data shows that the forward projections cannot fully capture is the behavior of the physical market itself under pressure. When silver first broke above $30 per ounce, every participant in the physical supply chain, from fabricators to industrial buyers to recyclers, said openly that the market was not structurally built to function at those price levels. The contracts, the lease structures, the forward sales, the refining arrangements, all of it had been calibrated to a world where silver stayed under $30. Now the market is operating at nearly 3 times that level, and physical demand has not collapsed. Industrial users are paying elevated prices because they have no choice. Solar manufacturers, EV producers, semiconductor fabricators, none of them have substitutes for silver that function at scale. The demand side of this equation is not price sensitive in the way commodity markets typically assume, and that changes everything about how the deficit compounds over time. There is a piece of history that explains why sentiment behaves the way it does around silver in particular, and why understanding it matters more than any single data point. In 1974, a declassified U.S. embassy cable, a documented government communication, not a theory, not speculation, described openly how the creation of a large gold futures market would accomplish specific objectives. It would make physical trading seem minuscule by comparison. It would amplify volatility in ways that discourage long-term holding. It would dilute and diffuse the demand pressure that physical scarcity would otherwise generate. They understood the psychology of paper markets and how to weaponize it 50 years ago. You do not need to force people to sell physical metal when you can design a paper market that scares them into selling it themselves. When silver dropped into the $72 range recently, sentiment did exactly what it was designed to do. Every voice in the metals space that had been bullish flipped to bearish almost simultaneously. Capitulation language flooded every platform, identified the structural support zone between $70 and $72, $60 before the low was printed. I showed the bullish swing failure pattern forming. I walked through the inverse head and shoulders setup that was developing when nobody wanted to hear it because the headlines were dark and the crowd was already positioned for further downside. Now, silver is at $84, $60, and the same voices that were capitulating at $72 are suddenly bullish again. Complete conviction reversal on a 5 to 10% move in each direction. That is not analysis. That is being managed by the market instead of reading it. The structure never lied during that entire sequence. The registered inventory data was there, the roll pace data was there, the Shanghai premium data was there, the LBMA lease rate data was there. Everything that mattered was visible in the primary sources for anyone who looked, and the headlines were telling exactly the opposite story. This is not unique to silver. It is how every major cycle transition works. The data tells the truth, while the narrative serves whoever controls the narrative. The ones who learn to read primary sources directly stop needing anyone to translate the market for them. Here is what Tuesday actually represents in structural terms. Shanghai reopens with a physical bid that is running $9 above Western futures pricing. That spread does not close by Shanghai moving down to meet New York. Historically, when this kind of premium differential has existed, it closes by Western prices moving toward the physical bid, not the other way around. The yuan is at its strongest against the dollar since May 2023, which means Chinese buyers have more purchasing power per unit of currency when converting to dollar-denominated metals, and that is not a small variable when you are talking about the scale of Chinese physical demand. COMEX registered silver has not seen a single new ounce enter the deliverable pool. The March open interest represents 222 million ounces against 88 million ounces of registered metal. The roll pace is dangerously slow with 4 trading days remaining. Gold held above $5,100, with China completely absent from the market. Think carefully about what the demand structure looks like when the largest physical buyer on the planet walks back through the door. The unresolved question that every serious participant needs to be watching is whether the COMEX March settlement produces genuine delivery demand that the registered inventory cannot absorb. If even a fraction of the open interest, representing that 222 million ounces, converts to actual delivery requests, the math between deliverable supply and delivery obligation creates a moment that the paper market cannot paper over with a roll. The vault reports are publicly available and updated daily. The Shanghai Exchange data will be visible Tuesday morning. The LBMA lease rate history is documented and publicly accessible. Everything needed to verify what the structure is actually showing is available to anyone willing to pull it. The ones who look find exactly what the data shows. They stop needing anyone to tell them what to think. They stop being managed by headlines. They become independent readers of the market, and that independence is worth more than any single trade. Watch the roll pace on Monday closely, because it will tell you whether the structural pressure is building toward a delivery crisis or whether enough contracts are rolling to give the market breathing room. Watch the registered silver figure Tuesday morning, because if new metal does not enter the deliverable pool, while Shanghai reopens with a $9 physical premium, those two data points together will say something very specific about where this market is heading. Watch the Shanghai Gold Exchange data when it opens, because the premium differential between Chinese physical pricing and Western futures will tell you immediately whether the demand that was offline all week is returning at the level the Shenzhen physical bid suggested it would. And if you have not pulled those vault reports yourself yet, Tuesday morning is the moment to start. Because this is not a market where you can afford to let someone else read the data for you. The silver market has not seen Tuesday yet. The bulls have not seen Tuesday yet. The paper market has not seen Tuesday yet. But Tuesday is coming, and the data is already telling you exactly what it is bringing with it. Invest with logic, not noise.